We'll start with computation of capital gains in case of depreciable assets. So in case of depreciable assets, how we'll compute the capital gains? What we should see is if V is greater than C. What is V? Full value of consideration. But that is the sale price should be greater than opening WDV, actual cost of asset acquired during the year, and expenses is connection to the transfer. If it is greater than C, then it is short term capital gain. If it is no, do we have assets in the blocks? Yes. Then if we have assets in the blocks, then depreciation shall be calculated. If we do not have assets in the block, that is the block cease to exist, then it will be short term capital loss. To understand this in a more better way, let's take an example. See now, here what happens is, whenever you calculate depreciation, what you will do is opening WDV of the block, add actual cost of the asset during the previous year. What actual cost you will add? Asset put to use for 180 days or more, asset to put to use 180 days or less, or acquired but not put to use, you will add in the block. So this is your opening WDV plus actual cost of asset purchased during the block of asset, less selling price of the asset, which is full value of consideration. Now what is this? This is full value of consideration. Okay, less what we'll do from the selling price less expenses connection to the transfer will be subtracted. Now WDV, this will be WDV for the purpose of depreciation, and we'll actually subtract the depreciation, we'll get the closing WDV. This is the way we generally calculate depreciation. Now what happens when the block of asset cease to exist? Sale price of the asset is 5,20,000 and say 7 assets are there, and your case 1 and your case 2 sale price of asset is 9,30,000 and 7 assets are there. Now opening WDV is 6 lakhs with 5 assets and 6 lakhs with 5 assets. Actual cost of asset acquired is 2 lakh with 2 assets, 2 lakh 2 assets, 8 lakh and 7 assets, 8 lakh and 7 assets. Now sale value is 5,20,000. 5,20,000 is the sale value, and the asset sold is 7 lakh. The block has ceased to exist. Now on whom will we calculate depreciation? That is no asset itself. So whatever we have, the closing is short term capital loss. Now here the sale price is 9,30,000. 9,30,000. Now the block of asset cannot be negative, so it should be restricted to 8 lakh. And what about the difference? 9,30,000 minus this 8 lakh will be your short term capital gain, because block has ceased to exist and the sale price is greater than opening WDV, actual cost and expenses connection to the transfer. Now for calculating depreciation, there should either be closing WDV and asset should exist. Both conditions should be there. Now here there is asset, no, but WDV is there, yes. So depreciation cannot come because both these should be there. So capital gains will come. Here asset is not there, WDV is also not there, so depreciation will also not come, capital gains will come, yes. So how to calculate capital gains? Full value of consideration is 5,20,000 plus less cost of acquisition is opening WDV plus actual cost 8 lakh. This is resultant short term capital loss. What is the full value of consideration here? 9,30,000 minus 8 lakh, 1,30,000 is the short term capital gain. Block can be nil but cannot be negative. In case of depreciable assets, there will always be short term capital gain and short term capital loss, where some block of asset continues to exist. Suppose there are sale value 9,10,000 and 4 assets are there. Your sale value 6,20,000, 4 assets are there. Opening WDV 6 lakh with 5 assets, 6 lakh with 5 assets. Actual cost is 2 lakh with 2 assets, 2 lakh with 2 assets. Now what happens is only 4 assets are sold for 9,10,000. So is there any closing WV? Do we know? Depreciation will come? No. Asset should also be there and WDV also be there. So short term capital gain will come. Capital gain will come. Your 6,20,000 is the sale value. We have closing WDV. Depreciation will come. Capital gains will not come. Now how to compute capital gain in this case? Full value of consideration less cost of acquisition, will get short term capital gains. Now in case of power sector units who have opted for the SLM method, WDV will be taken as the cost of asset. Now 50A we have already discussed that when we are selling market linked debenture or unlisted bond or debenture or unit of a specified mutual fund, then 50 it will always be short term capital asset. Now units of specified mutual fund acquired on or after 1st April 2023 and unlisted bond or debentures transferred after 23rd July 2024 will always be short term capital asset and will be chargeable to tax at normal rates. Unlisted bond and unlisted debentures will be charged at normal rate of tax. All these will be charged to normal rate of tax. Computation of capital gains will be full value of consideration reduced by cost of acquisition, because it is always short term capital asset, no index cost of acquisition, no deduction in respect of STT. Now what is market linked debentures? Market linked debentures is a security which has underlying component of debt security in the form of debt security, and returns are linked to the market returns. What is specified mutual funds? 35% of its share proceeds are invested in equity share of the domestic companies. Now we'll see capital gains in respect of slump sale. Now what is slump sale? There is transfer of one or more undertakings and you are receiving a lump sum consideration without being assigned. This consideration is not assigned to each and every asset, or lump sum consideration is given. Then such sale is called slump sale. What will happen to this? What will be the period of holding? What will be the capital gains? What will be the cost of acquisition? Now here we should check 36 months as the period of holding. If it is hold for more than 36 months, it's a long term capital gain. If it is not, it is a short term capital gain. Will indexation benefit be given? Indexation benefit would not be available. What will be the rate? Long term capital gain transfer took place before 23rd July, 20%. Long term capital gain after 23rd July, 12.5%. In either case, no indexation benefit will be given. For short term capital gain, normal rates of tax. Now how to compute capital gains? Generally it will be full value of consideration minus cost of acquisition. What will be full value of consideration? Full value of consideration will be higher of FMV1 and FMV2. Higher of FMV1 and FMV2. What is FMV1 and what is FMV2? FMV1 is fair market value of capital assets transferred. What assets are transferred, uski fair market value will be FMV1. What is FMV2? Fair market value of consideration received by way of slump sale is FMV2. Deemed cost of acquisition, cost of improvement. What will be the cost of acquisition? See, FMV1 is what we have transferred, FMV of what we have transferred. FMV2 is FMV of what we have received. If it is monetary, take the monetary value. It is non-monetary, take the FMV value, monetary and non-monetary. Now this is full value of consideration. What will be the deemed cost of acquisition? Deemed cost of acquisition will be net worth. Now how to compute net worth? Net worth will be assets, aggregate value of assets minus value of liabilities appearing in the books of accounts. Now if we are taking the assets, should we take at the revaluation figure or book value? Revaluation effect should be ignored. Now, what all assets will be included in calculation of total assets? See, all the assets will be included except this self-generated goodwill of a business or profession. Its cost of acquisition we have seen also will be nil. So here also we are not taking it. 35 AD for scientific expenditure we have taken 100% deduction. In such case also we will not take this. We will be taking the value of asset as nil. In case of any other asset, we'll take the book value. Case of depreciable assets, we'll take the WDV value. Minus value of liabilities will be the net worth. This net worth we have to subtract from the full sale consideration. We'll get the capital gains. On this capital gains, if the period of holding is more than 36 months, we have to compute long-term capital tax, and less than 36 months, we have to compute short-term capital tax. Now we'll see how to calculate deemed full value of consideration in case of land, building or both. So first, see, we are having full value of consideration, right? And we are having stamp duty valuation. If our full value of consideration is less than full stamp duty value, that is stamp duty value, and if a full value of consideration is less than the stamp duty value, and if it is only less than say 10%, okay, then or greater than 10%, so fluctuation is only within 10%, then we can take full value of consideration itself. If it is more than, the fluctuation is more than 10%, then we need to see whatever is higher. See, for example, see, if stamp duty value is greater than 110% of consideration received, then stamp duty value will be taken, because stamp duty value is more than 10% of the full value of consideration. The fluctuation is not within 10%, but it is more than 10%. However, if the stamp duty value is less than 110%, see, in both the cases, it should be more than 100. Stamp duty value is greater than full value of consideration, but if it is more than 110% of consideration, we'll take stamp duty value. If it is less than 110% of consideration, we can take consideration received itself. So 10% fluctuation is allowed if stamp duty value is more than full value of consideration. Now we should take stamp duty value on date of agreement or date of transfer. We should take the stamp duty value on the date of agreement if we have received some amount through electronic clearance system, RTGS, IMPS, UPI or any mode of banking channels except cross-border check. If we have received any amount before date of agreement, then date of agreement will be stamp duty value. If we have not received any amount, then date of transfer stamp duty value will be taken. Now, if consideration, now what happens is, where the assessing officer refers to the valuation officer. Now, assessing officer is not happy with the stamp duty value. He is referring to valuation officer and claims that stamp duty value exceeds the FMV of the property. And stamp duty value has been disputed. Then what will happen if the valuation officer see, if he says that stamp duty value is too high, then what happens if the valuation by the valuation officer is greater than stamp duty value? Now what valuation officer does is he has taken value which is more than stamp duty value itself. That in that case stamp duty value itself will come if valuation by valuation officer is less than stamp duty value. No, assessee, what he has told is correct. Stamp duty value should have been lower than valuation officer. Valuation by valuation officer will be taken. See, when there are unquoted shares and it has been sold, and if the consideration received is less than the FMV determined in the prescribed manner. What I am selling is lesser than the FMV. In case of unquoted shares, then FMV of such shares will be taken as for full value of consideration, where the consideration received as a result of transfer is not able to be determined, then FMV will be taken into consideration for determining of full value of consideration. See what will happen in the case where advance money received is forfeited. Now see, for example, we have bought some capital asset, okay, and that capital asset we want to sell. It is bought by A and it wants to sell to B. It made a contract and negotiation has been done between A and B. Now what happens? A has took some money from B. Now what will A do? B has failed to the tax treatment of advancement from failure of negotiation. Now the agreement has failed. Okay, what happened is the agreement has failed. Now what A does is A forfeits the amount. Now what happens is A has a capital asset, A has money received in advance, and A forfeits that money. Now what will happen in this? What will be the tax applicability if the advance money is forfeited before 1st April 2014? If it is forfeited before 1st April 2014, it should be deducted from this cost. There will be cost of asset, right? When this asset is sold to any other party, we will subtract minus cost of asset, right? From this cost of asset, this money should be subtracted and the reduced cost of asset will be shown and the resultant capital gains will be computed. So this is the case if the advance was received and forfeited before 1st April 2014. If it was, now if advance money is forfeited after 1st April 2014, it will be taxed when we are forfeiting itself. That year itself will be taxed as income from other sources. So what year is taxability is postponed to the year of transfer of capital asset. Taxability is subtracted in the year of forfeiture of advance. Now we'll see exemptions from capital gains. Exemption from capital gains is divided into two: exemption under section 10 and exemption under section 54, 54B, D, E, C and F. So we'll take up first sections before B, D, E, C, F and 54. So in all these cases, what we will see is who will be the eligible SSE, who will be the eligible SSE, which asset should have been transferred, what are the additional conditions and if any, whether it should be long-term capital asset or short-term capital asset, whether there is any lock-in period, what happens if we violate the lock-in period, within which time new asset should have been purchased, and any other conditions, if any time limit for depositing in capital gains account scheme. So let's start with this. Okay, so let's start. Eligible SSE for 54 section will be individual and HUF. There should be transfer of residential house, buildings or land apparent thereto. Land buildings apparent thereto means parking area, garden area, all that will be included. So there should be a transfer of residential house. It must be a long-term capital asset. Income from should have been charged to income from house property. Income should have been charged to income from house property.